Good afternoon, everyone. Thanks for joining us today. Welcome to the Robotti Mid-Year Update, August 2025. I'm David Yazdan, and I'm joined today by Robotti & Company's founder, Bob Robotti, and portfolio managers Curtis Jensen and Isaac Schwartz. As Bob will get into, Robotti & Company has a unique team and structure and process that has attracted exceptional investment talent over the years. Bob has assembled a group of original thinkers with differing expertise and backgrounds. Our research team consists of 14 investment analysts, including Bob. 9 of the 14 have worked together for over 10 years, and 6 have worked together at Robotti for over 15 years. It's a deep and cohesive team, which is difficult, if not impossible, to replicate at firms of similar size. After we hear from Bob, Isaac, and Curtis, we'll open it up to Q&A. So if anytime you have a question, you can click on the Q&A icon at the bottom of your screen, type in your question, and then press Submit. We'll address your questions at the end. Now, before I hand it off to Bob, I'll mention some upcoming events and other media-related communications. For those of you who are new to Robotti, we've put together and produce a plethora of informative content, from commentaries, articles, podcasts, video interviews, and more. Please visit our website at robotti.com and click through to the media and events page for links to replays, including an in-depth discussion on our holding Subsea 7's merger with Saipem, featuring Bob Robotti and portfolio managers Theo Vandermeer and David Kessler. We often host fireside chats or live video interviews with many of our top holdings, both in person and virtual. Our next one is a breakfast meeting with the CEO of Subsea, John Evans, next week in New York. Isaac Schwartz, who you'll hear from later, will be hosting his 9th annual New Silk Road Forum 2025 next month in Istanbul. Coming up in October, Bob will be the keynote interview at Latticework 2025. That's MOI Global's full-day event in New York. And I'll mention just 2 of Bob's recent podcasts, but trust me, there's more. Bob was interviewed on Other People's Money podcast, where he discussed investment opportunities resulting from North America's huge industrial advantage. And for a hint, it's not tariffs. And the other podcast interview by SumZero on the restoration of the fallen, where Bob highlights the shifting landscape, which appears to be tilting in favor of active, valuation-oriented managers. And back in June, Curtis Jensen presented his investment case for U-Haul at the CFA Society of New York's Ben Graham Conference. Please reach out to us if you'd like to receive the video replay. And I'll mention one more. Back in November, Robotti research analyst Spencer Sibeli hosted a virtual fireside chat with Gavin O'Dowd, CEO of our holding Hape Group of Sweden. So again, visit us at robotti.com, or better yet, come visit us at our offices in Midtown. We'd love to see you. All right, so let's get started. Bob, before you start your conversation with Isaac, tell us how the Robotti team and process position our clients well for today's investment landscape and beyond.
Before I do move on to that description, I do want to start with that comment. It's the restoration of the fallen, and the fallen in my mind is active management and that's stock pickers, and therefore that's the important component of the firm. There are 14 people here who are all stock pickers, right? We're doing extensive research looking for businesses that trade in public markets far below what the value of the business is. So A, valuation matters, and then secondly, of course, looking at each one of those companies and trying to identify characteristics, fact patterns, the future opportunity for significant growth in the earnings, because that's what it is. We want to buy things at discounted valuations, but clearly an important component is the ability for those earnings to grow over time, an identifiable pathway to that. And that's why having 14 people who independently look for ideas is a critical asset of the firm. And David mentioned had a comment that says for firms our size, that's a significantly larger staff of research people than you would find. And that's because it's a critical element of the firm. We are not, and of course, the different size firm what he's referring to is in the asset management, everybody talks about what's your AUM, what's your assets under management, and that's an indicator of success of the business. That's not the measure of success of this business, right? The measure of success of our business is identifying companies that people have not identified and understand, and for us to invest capital to get returns, because we're in the business of generating good returns on risk-adjusted returns, and we're not in the business of raising assets for the business of making a bigger business. So that's a critical fact, and the people and the structure in the organization facilitate that. What I also would emphasize is that those 14 people look where the opportunities are and not where the market thinks is popular, and that's frequently, of course, the things that are not popular. And therefore, specifically, Isaac and Curtis are on because their strategies have a larger component of looking overseas, right? One of the markets that's been ignored, discounted, is U.S. small cap, especially heavy industry businesses. And so that's the historical focus. And plenty of us here at the firm are identifying securities in that marketplace that are cheap and undervalued. But in addition, we are looking, because the overseas markets have been markets that have underperformed dramatically, and yet businesses have done well, and therefore there's a significant opportunity set in overseas markets, and both Isaac and Curtis know that, realize that, and have a deep experience in investing in those markets, and so that's a critical aspect of their strategies. So Isaac, so I met Isaac in 2001, and when he was a freshman at Wharton, and when he graduated in 2004, on his own dime, he took a trip for 3 weeks across Asia, and came back and said, "Bob, we have to invest overseas. There's a huge opportunity." So my initial reaction is, I'm a kid from Queens. I don't speak English that well, and so I don't speak foreign languages. How could that possibly be? But I figured he's a smart person. I should try different things, and so I followed him, and we started treks to Asia. And of course, it was really fortunate because my hesitation, my concern about how that's not investable for me, and taking me to places where opportunity sets were long, and I could understand that process, and therefore, in 2007, we committed more capital to invest to take advantage of what we thought, because what we saw were two things. One, Mr. Market is more manic depressive, right? So therefore, valued investors know that's what you want, a manic depressive market that misprices securities and gives opportunity for someone to thoughtful analysis for stock selection. And the second one was that there really are significant opportunities in terms of these economies. So through those initial travels, that's what it was. Isaac, of course, then relocated to Asia. So we lived 6 years initially in Singapore and then in Hong Kong, and then traveled around extensively after that. Fortunately, when he was visiting in Istanbul, and Theo Vandermeer and I went to visit him, and then he took us across the Black Sea to go visit public companies in Kiev. That was before hostilities broke out, so that we were unaffected by anything adverse on our trip to Ukraine. But what Isaac also did starting 9 years ago was the network of knowledge and information in companies and countries. He's been able to catalog and characterize it and compound. So he started his new Silk Road Forum. So once a year, he gets together with people that he's met through these travels and the network of people that he's developed, and continues to compound that organization, that group, those people, and the number of people grow, and the information exchange continues to also compound. And so I look forward to, in September, being in Istanbul to join him for the 9th New Silk Road Forum. So I think that's a really good encapsulation of what Isaac has spent 2 decades creating. So Isaac, of course, when I say investing in emerging markets, there's probably many people who think to themselves, how can I do that? I don't understand it. Can you help the listeners understand and demystify that process?
Thank you, Bob. The first step for any investment, I would say, is valuation. And that's the ultimate demystifier, because all the other research that we do comes out of that. 20 years ago, when I was first looking to Southeast Asia, our first market was Thailand. And the reason I was excited about Thailand was because it was less than a decade on from the Asian financial crisis, and the market had been forgotten about, where there were plethora of companies at low PE ratios, at high dividend yields, that had been in a recovery mode from the financial crisis, where they had really great balance sheets. And importantly, because Thailand had had a lot of booms and busts over the years, their records as public companies were longstanding. You could read, in many cases, decades of public English language filings by these companies. So whether I'm investing in the U.S. or whether I'm investing in some emerging markets, I would say the thing that inspires our research is the idea that something might be fundamentally undervalued and that we can explore that. And then, we threw up a couple of the things that we care a lot about, which all follow on that research process. Of course, the firm's capital allocation, which to me is the hardest evidence of what the corporate governance really is. Whether or not the management engages with the public is beside the fact of what they do with their cash flows, how they invest, how they pay out capital.
Great. Thanks, Isaac. So, of course, that goes back to the initiation of the process 20 years ago at my travels to join you to travel all around Asia. But could you give us a more current example, an exemplification of something investing in the markets that other people might be totally mystified by?
Some markets that I'm very interested in today are in Central Asia and Eastern Europe, and in particular Kazakhstan. Of course, you and I and Theo and other colleagues looked at Mongolia 15 and more years ago. I also took time when I was in Asia looking at some of the other markets in Central Asia. And I remember the first time going to Kazakhstan in 2010, realizing that the market was already decades economically advanced past some of its neighbors, and yet still really, really off the radar of investors. Even at the time I was living in Hong Kong and spending a lot of time in China, which shares a big border with Kazakhstan, and even investors there were not even thinking about the region. And so, this is an example, like Thailand 20 years ago, we came to it first because of valuation. And then, years into researching Thailand, came to understand that Thailand has a large number of extremely high quality businesses, a very diversified economy with a lot of individual industries that it has competitive advantages and excellence in. I would say that's echoed by some of the investments that we've identified in the former Soviet sphere in general, but in Kazakhstan in particular. That of course I looked at first because the valuations were low, but now from many years of investing over there and researching the area, can also say that the opportunities are very good and that there's a lot of high quality businesses.
Isaac, let me digress for a moment, and that is Kazakhstan. You mentioned a long history with it. I guess as your new Silk Road Forum, how many people will be there from Kazakhstan? You'll have a big contingent to continue to develop that network. Is that correct?
Indeed. We'll have more than 50 people join us in Istanbul, and 10 of them will be coming from Kazakhstan from all sorts of different areas, private investors as well as other sorts of investors. So it's a great way.
So can you give us a current example of something in your portfolio that is a manifestation of this knowledge base in identifying what's of interest in Kazakhstan?
Sure. Air Astana, that's the national airlines of Kazakhstan. This is a very cheap stock, first of all. I guess I've always been interested in aviation. I went to flight school and I'm a pilot. I've been an investor in emerging markets airlines for many years, including in Turkish Airlines. Air Astana has been on my radar a long time. I think I flew on the carrier for the first time 15 years ago. I met the CEO of the company for the first time 10 years ago. And so I was already very aware of it when it went public 2 years ago. Today, this is a fallen angel IPO that we've started investing in this year. And that I think is not just a cheap stock. On a valuation basis, it is one of the cheapest airlines in the world on an enterprise value to EBITDA basis. It generates very attractive margins, even with an industry leading cost structure. But I also just happen to know that they have an extremely strong long-term record, and they have a great growth plan ahead of them.
So you do mention how long has it been around, and who are the people behind this business, and how successful has it been over an extended time before its IPO opportunity?
The company was set up 25 years ago with a very small amount of capital by two founding shareholders, the Sovereign Wealth Fund of Kazakhstan and BAE Systems, the largest defense contractor of England. And from that small base of capital that the company was established with, it has grown profitably and expanded from a few planes into more than 60 full-bodied aircraft today. I think an example of what an excellent company this is came in the lead up to the IPO, which wound up delaying the IPO a little bit, which was the difficult situation in the region with Russia and Ukraine. At the time, 10% of the capacity of the airline was going through Russia, and instantly that had to be brought down to zero because it is a Western carrier flying to all Western countries and insured in Switzerland, insured in Lloyd's, and so unable to fly through Russian airspace. And it was the way that they reallocated that capacity so quickly, just a bare hiccup to the business that really reinforced to me that the successful record started by the small capital investment in the early years and the steady growth of the early years is something that the company in its larger shape today is very much prepared to continue. And we've seen that with attractive routes that they've expanded into South Asia, Southeast Asia, things like business travel into India, tourism travel into Vietnam. Some very attractive opportunities for the company.
In addition to interesting strategy, well managed, a strong history, of course, you did mention valuation as the initial point of it, and because of the fall in IPO, could you give me the numbers again? What's the market cap? What's the net cash or net debt on the balance sheet, and what's the EBITDA numbers on the?
The market cap of the company is $600 million. It has about $500 million in cash, no debt, but it has $1 billion in airplane leases, and it has about $300 million in EBITDA. But importantly, it's really the growth in the business, which is predicated on the cost structure that they've been able to maintain, taking on a very wide variety of flight and target customer segments that I think is so exciting. And because valuation is the starting point, but it's really our long history with Kazakhstan as well as with the company that enables us to act on it.
And it sure seems that if it has a balance sheet that will facilitate its being able to grow when it identifies opportunities, right?
I think that they know that they're a fallen angel IPO because I noticed they've actually started because it's trading significantly below where they went public, and they have that balance sheet flexibility. They're even repurchasing shares for.
Right.
Interesting.
So Isaac, when your investing strategy is interesting in that there's a significant portion of the portfolio that is invested in emerging markets, and yet there's a significant portion of the portfolio that's invested in developed markets. Could you tell us how that comes together, how that makes sense, and what's your strategy there?
Again, it all starts from valuation, and valuation being the inspiration and the catalyst for a rigorous research process, which for me, has never does not mean pigeonholing oneself in one category of investments. I think there are two reasons that it makes sense to be flexible between different sorts of markets, between developing countries, developed markets. One is simply that it would behoove an investor to have exposure to a lot of parts of these world, to a lot of these parts of the world, because there are transformative economic dynamics in place, and there are some extraordinary businesses and extraordinary opportunities, and it makes sense to have exposure to places that that we have long invested in, such as Southeast Asia, such as the region we were just talking about, Central Asia. But there's another reason also, which is that fundamentally, what is a developed market investment? What is an emerging market investment? There's so much crossover between these things. I think it makes sense to to be flexible and to consider how companies can operate in one place and be economically exposed to another, and vice versa.
So I'm gonna push you to share a company with me, an investment idea. Give us an example of one of your developed market investments and its investment merits.
We're investors in Chung Kong Hutchison Group in Hong Kong, which is a developed market company. It's in Hong Kong, but really this is a complicated, mainly developed market company, but operating on a global basis. It's a holding company that owns the largest drugstore chain in the world, operating across Europe and Asia, one of the largest telecom conglomerates across Europe, operating across consumer markets and also B2B infrastructure in telecom. And then it's been in the news this year because Chung Kong owns a major global ports business that operates in more than 40 countries and has been in the news recently because they own the two ports of Panama, which are now the subject of a political dispute.
Great. And could you give us something on valuation here too? I have this belief that the ports which are a small portion of the total assets of the company, and yet there's a transaction that potentially values them at something vastly different than the market cap of the company.
Sure. We invest in other ports businesses, and a well-run port is a very basic and stable infrastructure asset that generally would trade on a yield. When you buy it inside of this conglomerate, it's at a big discount, as you alluded to. This conglomerate trades for less than half of book, trades at a high mid-single digit PE, a very high mid-single digit dividend yield. And indeed, they have this one asset which we believe might be sold, and then the numbers that are going around just for the Panama ports are something around the level of the market cap of the overall group. So
are you suggesting that it's better to maybe invest with an owner, operator, manager who has significant interests, has built a phenomenally successful business, who is aligned with the shareholders, versus necessarily being the buyer of that asset at a full valuation with other people's money in a private equity firm? You think so you'd rather invest with the owner, operator, manager at a significant discount than at full value with someone else's money in a structure that is high fees?
Indeed, with as you say, an owner operator,
right,
with the core bulk of their own personal net worth, with
right,
an extremely long and successful established track record themselves,
right,
now selling one of their major assets to to more like a trader and financial buyer.
But haven't you heard nobody buys stocks in Hong Kong anymore? All the capital continues to come out of Hong Kong listed companies, so it's not a place to be invested.
Indeed that the main index, the Hang Seng, peaked almost 30 years ago, and trades lower today. That's a big chunk of time for anybody. And here you have a collection of assets that are global in nature. If anything, are mainly European. If you look on both a revenue and operating income basis, are primarily European. But it's listed in one place. It's affected in another place, and it's the reason why we are flexible investors who will invest across emerging and developed markets, and we're and we love the research process here, right, and so we're focused and we're able to see where the actual impact is coming from to the company.
But I see we're supposed to be invested in the popular things, not the well-financed, well-positioned, great investments. Anyway, thank you so much. Appreciate it. I'm going to turn it over to David. As long as I've known Isaac, and that's 24 years, I guess David and Curtis have even a longer history. David, please.
Yeah, thank you guys. Very insightful. Thanks, Isaac, as well. It's clear Robotti's rigorous investment process can be applied both home and abroad. Now we're going to hear from my colleague, Curtis Jensen. I met Curtis Jensen back in 1996 when I joined Third Avenue Management, the investing firm of the late Marty Whitman. I had the fortune of working with Curtis for 15 years at Third Avenue, where Curtis managed the small cap value strategy and was the firm's CIO. Now, part of the allure for me joining Robotti 2 years ago was reuniting with Curtis. Don't worry, Curtis, I'm not stalking you.
Hey, yes, as you're going down memory lane there, I'm reminded of our exploits on the hardwood as part of the Third Avenue basketball team. I think we made some real highlight moments there.
We did. We brought home the hardware. We're number one in the conference.
What do you?
It was the C-League conference.
You're saying going down that lane? Were you driving down the lane? Was that a layup you were trying to do there?
We could bring it to Robotti. We could bring the the winning to Robotti. I'm sure there's some athletes here, but seriously, it's I believe Bob and the team have really created an environment here that's very investment friendly, and it feels like home. And so, and maybe that's a good place to start. Let's start with your investment friendly strategy. Not unlike Marty Whitman and Bob Robotti, you're not trying to manage to a benchmark or fit nicely and neatly into a style box. Tell us a little bit more about your thinking of having this flexible, less confined mandate.
Well, thanks, Yaz. That flexible style really does take me back to my roots at Third Avenue, where Marty was managing a go-anywhere strategy. And it was a strategy that I thought made a heck of a lot of sense from an investment perspective, although it was frustrating to allocators who couldn't put us in a box. So I came to Robotti with the idea that I wanted to maximize the opportunity set while also being selective about the sorts of investment risks that I was taking. And I wanted some diversification for my own personal capital, diversification away from consensus mainstream thinking. I think one of the great things about being here at Robotti is I'm surrounded by long tenured analysts, folks who are passionate about investing, and they're coming up with ideas from all over the place. You just heard Isaac talk about how he's originating and identifying ideas literally from across the globe. And why cut myself off from those ideas? So it kind of reminds me of that line from the movie The Miracle, the story about the men's 1980 U.S. hockey team, where Coach Herb Brooks says, "I'm not looking for the best players, I'm looking for the right players."
I like it. That makes sense. Good team. And you talked about being selective and avoidance of risk. Maybe take us deeper in that in terms of what are some of the key characteristics you're looking for in investment. Tell us more about your process there.
Sure. I preface all of my comments about those characteristics by saying I try to make my life easier. And when I start out, I try to eliminate all the hard things. And there's certain things I can eliminate right off the bat. I've got some examples on the slide here, but there's a lot overhyped stocks and bad people and stupid deals, and all of those I can put them off to the side as a starting point. It's evident today too that there's just tons of speculative behavior coming out of the woodworks, and I think a lot of investors are asking themselves the wrong question, which is how much money can I make, how fast? So to take that step one further, I try to invert that a little bit, and I almost start with a pre-mortem, meaning, I ask kind of what can go wrong and, what kind of mistakes can I make here and what are the pitfalls in investing? So on the slide, I've got just kind of a summary checklist that summarizes, some of the main reasons you get a bad outcome in investing. So the main components of my approach really are, starting with the balance sheet, making sure the balance sheet is strong, that it makes sense relative to the risks in the business, looking for a long runway of growth in the business, one where there's attractive reinvestment opportunities, especially. And then, of course, there's comparing the public market price to an estimate of intrinsic value or private market value to get an assessment of whether the stock or the security really is mispriced in the public markets. And then I think a lot about management, their track record as operators and also as stewards of capital. And I try to consider their incentives and what's really motivating them. So one of the things that's nice about public market investing is there's an awful lot of disclosure about these areas in public company filings if you're willing to go through them.
Okay, so let me recap again. Some of your preconditions: strong balance sheet, clear runway for growth, discounted valuations, and management teams that think and act like owners. And you and I talk a lot about the benefits of family-controlled public companies. And we've seen a lot of research showing from academia or UBS that family-controlled public companies actually over time outperform the general market. And I would imagine honing in on some of these real value creators would even be turbocharging that to some degree. How do you do that? How do you find those types of owner operators, stewards of businesses to select your portfolio?
Given the criteria we talked about, one of the attributes that pops out of the idea funnel are companies where there's a founder involved, or a family or a group of executives with outsized ownership, where they either have control of the business or de facto control. You tend to find owners that are laser focused on long-term wealth creation. They're not focused on short-term earnings, quarterly results, and other short-term metrics. They really tend to think generationally, and as such, they will tend to finance themselves conservatively, even if it means trading off a bit of returns for an element of resilience and safety in the business. Of course, they have their own money at stake. It is their own money, so they are watchful over the expenses. And these structures tend to develop, I think, strong cultures that lends itself to stability and kind of a shared mindset across the whole organization. One other note is, it seems like people are tripping over themselves to get into private equity. So part of my strategy is to align our capital with these kinds of companies that strike me as very private equity-like, but with some advantages over traditional private equity. I mean, what does private equity really get you? It gets you access to ideas that might not avail themselves in the public markets. But you have the advantages of liquidity because, of course, these companies are listed. You have truly, I think, uniquely permanent capital, unlike a finite life fund. And you've got low costs. So on the one hand, I think there are a lot of elements that make this private equity-like, but very different from traditional private equity. The trick is really to separate the wheat from the chaff. You have to be selective in identifying the executives, the boards, the owners who are energized and rational and dynamic in how they manage the business. And they're not just caretakers or empire builders. So I think those kinds of ingredients, align the interests with investors like us and improves the odds of a good outcome.
So let's pivot then. I'm looking at your slide here. It looks like an interesting collection of businesses. Some I know, some I don't. Where are you finding these types of opportunities? Bob and Isaac focused in on emerging markets and some of the dislocations there. Where do you seem to be finding some of these opportunities?
Well, the slide's really meant to be illustrative of the kinds of companies, investments that are held in our strategy. One of the things Bob talks a lot about is the capital cycle. If you could see the books, there's a book on the shelf behind me called Capital Account. It addresses this idea of the ebb and flow of capital in and out of industries and businesses. And I think Canada, which figures prominently in our strategy, is a good example of this. How capital flight opens up opportunity for investment. We've been in Canada for some years, and if you kind of think back to what Canada has been like, especially if you're in the resources industry, the Trudeau government was very hostile to the oil and gas industry and extractive industries generally. That impeded development of the assets. You could layer on, ESG constraints that were present in recent years. That drove capital away. And you had foreign companies selling assets in Canada, at least in the oil and gas area. So you had companies like Shell and Marathon and Conoco and Statoil selling their assets. And who were they selling their assets to? They were selling their assets to the locals, which I thought was curious because presumably the locals know a lot about the quality of the assets. So it was clear from the discounted valuations that the sector had been left, that the oil and gas sector in particular had been left for dead. And what else was clear in my mind was that the world was going to need more energy in all of its forms. So putting those two together really piqued my curiosity. And I started looking at the upstream oil and gas business in Canada. And what became apparent is that there's, well, of course, an enormous resource in Western Canada with great geology, long lives, and low costs. And many of the companies are led by the kinds of owner-operators that we just love, gals with great track records of true value creation, which is particularly impressive given how treacherous the oil and gas business is. So out of that, we've created a basket of oil and gas names, I think, with great prospects. Another area, of course, has been Europe. In our case, it's been a particular focus on holding companies where you get really conglomerate structures with diverse business lines. There's been a lot of skepticism about Europe in recent times, about Europe's growth prospects. I think some of that started to change. They seem to be getting some religion potentially about their defense needs, their infrastructure needs, changing their energy mix, their energy suppliers. There's been this notion of American exceptionalism that's attracted gobs and gobs of capital, and it's drawn all of that capital, it's been drawn away from other markets, including Europe and Asia and other places. What happens when capital gets sucked away, valuations compress, and as capital becomes scarce and valuations fall, another thing happens, and that dynamic can often inject a new urgency in management teams. So it's that idea where capital's been taken away, all of a sudden management teams and boards become really focused on and really sensitive to their cost structures and where and how they allocate their capital. So the names on the slide are really just kind of representative of the criteria that we've been talking about and illustrate these kinds of companies really can come from all different business lines and segments.
So thank you, Curtis. I could keep asking questions, but we want to leave some time for Q&A with our audience. But before let's go.
Before that, I'm going to jump in quickly on one of Curtis's comments. He was talking about Canada, oil and gas, and I think that's part of the advantage. Right, I've been going to Canada for 25 years and have a full appreciation, and that's what it is. As difficult as it's been, it's great because the geology is there, the resource is there. God put the resource there, and therefore it's been left behind. In the meantime, there have been two significant events. One is the now starting up gas pipeline that takes natural gas away from Canada, enables them to sell to Japan, the best market in the world, instead of having to discount it to sell it to America. and they've increased the oil that goes that way too. So therefore, its connectivity to Asia is a huge opener and changer, and the resources there. So that's a huge opportunity, and the valuations mean that U.S. capital and foreign capital will come back over the next few years, and it looks like I would think it's a extremely right place for corporate transactions to eliminate the discounts at which the things Curtis is investing in are trading at public markets. Sorry.
Thanks,
That's all
Bob.
right. Thanks. No, thanks, Bob. Before we go to Q&A, though, Bob, do you have any additional remarks or takeaways?
I want to reemphasize it's the restoration of the fallen of stock pickers, and stock pickers go where the opportunities are. They do individual stock research, and there's a huge opportunity set. The things that capital has flown out of for an extended amount of time, valuations are modest. Growth opportunities are clear and identifiable and significant, and that really does make for the opportunity. So in the next decade, it's which needle you pick out of which haystack, and not which haystack and you buy them all. So I really do think things are changing. I do think the flow of capital is continuing to increase. Here you've got volatility in the markets, and part of that is you buy a whole haystack because the Fed's going to do this or tariffs are going to do that, or you sell the whole haystack. So therefore you get stocks going up 10, 15, 20, 30%. And for a rational, reasonable, thoughtful stock picker, as opposed to a person throwing money around, that's a huge opportunity set that we're in a well-researched position to take advantage of. So with that, I go back to questions.
Thank you. Terrific. Yeah, let's go to Q&A. Again, as a reminder, if you have a question, just click on the Q&A icon at the bottom of your screen, type in your question, and then press submit. First question. Well, let's do a combined question for Isaac. What about country risk, specifically Kazakhstan, good governance, rule of law, who owns the company? Help us understand country risk, how you assess that for companies operating in non-Western countries.
We assess it rigorously, is what I would say. I mean, in the case of the two countries we were talking about earlier on the call, Thailand and Kazakhstan, one of them we've been investing in for 15 years. One of them we've been investing in for more than 20 years. In each of those markets, we've invested in each market more than 20 companies with the fullness of time. At this current time, I'm an investor in one company in one of those markets and three companies in the other one of those markets. But what I would say about the research process is that there are so many different. We start with valuation, but there are so many different things to worry about with any new company you look at, whether it's in a new industry, in a new state within the U.S., in a new country. If the question specifically is asking about Kazakhstan, I would point out that the companies that we're investing in there in that country today have very strong shareholder bases that ensure really high quality corporate governance. In addition to that, there is such an important interest in developing the capital market further. There are only about 70 companies, 70 companies that have public quotations on the domestic stock market in Kazakhstan, and then maybe about 20, most of which are dual listed, but about 20 that are internationally traded. There are so many candidates to do IPOs in the country, both that are majority controlled by the Sovereign Wealth Fund, since the country did have a history prior to the 1990s of being a communist transition country. And therefore, about 25% of the GDP of the country is still linked to government-linked businesses. So there's a very large backdrop of IPO potential, and in the companies that we're investing in there at this moment, which are in financial services and aviation, these are industries that have very, very high levels of oversight. In aviation, due to the freedoms of the air, airlines are regulated reciprocally by all sorts of countries that they land in. So just like the UK Aviation Authority regulates Delta, which lands in the UK, it also regulates Air Astana, which lands at London. The banking industry in this part of the world was very severely hit by the global financial crisis 17 years ago, and the result of that has been a number of things happening. First of all, much improved regulation and oversight of the sector. In addition to that, there's been a lot of consolidation in the sector that I believe positions the companies there in a very good way. At our next New Silk Road Forum next month, I'm looking forward to interviewing the recent governor of the Central Bank of Kazakhstan, who's a friend and a successful businessman in the private sector now. So there's just such there's really a kind of a panoply of markers. Bob, is there something that you would add to that?
I would, of course, it is next door neighbors. It has the longest, one of the longest land borders of the world with Russia, and it has a long land border with China. And as we know, the senior members of the government of Kazakhstan, they've identified dealing with those people with sharp elbows as something in which that encourages in them to have U.S. and Western ties as a potential counterbalance. And one of the things that there is a counterbalance is 40% of the world's uranium is mined in Kazakhstan. And so therefore is a critical producer of a critical material that clearly the world's in the process of growing out its nuclear power and nuclear generation. And this country plays an important role. And therefore that does a lot of things that extra influences the West and the United States interest in the ability of this country to continue to have an independent capability to do business with on a reasonable basis its neighbors when it does that.
Thank you for making that point. I think it's an interesting thing to consider in a lot of emerging markets. Sometimes the country-specific risks wind up being overweighted in investors' minds, and therefore the company-specific risks wind up being underweighted, and it can be vice versa. So indeed, Kazakhstan as a nation has strong governance because of the influence of the U.S. and the West and China and Russia. And then just to circle back to the company that we were discussing earlier, it's 17% owned still by its founding partner shareholder, BAE Systems of England. So I believe that the Kazakh Sovereign Wealth Fund, which owns 41% of it, itself has extremely strong oversight, is well understood at the very highest levels of power in the country, that entity being well run and achieving good returns on capital and being run in a fair way is good for overall society. And so that's a strong shareholder. The other large shareholder is a strong shareholder, and now having 40% of the company public, just over 40% in public hands, is another layer of oversight that's important.
Another positive is it's gone through a transition in the federal government, right, the highest levels. So a number of years ago, the original president who ruled for many decades did step down. He was succeeded by a new president who's been in office for an extended amount of time. And the governance process has substantially changed and broadened out, and therefore the power at the top has been reduced. So like neighbor Uzbekistan, who did that recently also. So both of those countries are making a transition from original ruler who ruled for decades in a relatively, having come from a Soviet background and a Soviet mentality, having transitioned to a government that clearly has a more democratic, cooperative government. That therefore, I think are significant developments that have happened over the last couple of years in both countries.
And this sort of research process naturally takes place on an extended basis. I mean, I know how many times I've been to Kazakhstan over the last 15 years, but then, Bob, you've been with me. You've been there several times. Theo Vandermeer, our colleague, has been several times, and some of our investors have come with me over the years. And so it's that sort of slow research process where, then boom, a company goes public, and suddenly 2 years later it's trading at a lower valuation, and it's actually something you're familiar with.
So John, you asked the question. I will tell you, I was unfortunate because we were in Oman at the same time. We could have introduced you to a number of people from Kazakhstan that we do know that do go to Berkshire to think about how Berkshire thinks about things, and therefore, they are believers, and so therefore, there is more information that we have from senior people, being government people, being business people, in terms of how they think and how there is a Western attitude that permeates the country.
This next question is probably for everyone, but why don't we start with Curtis? And it's a general question. Can you elaborate on your portfolio management process, how to size a position, and when to buy, hold, sell? Thanks.
Well, I think position sizing is as much art as it is in science. Part of it is guided by, in my case, whether I can sleep at night. So I keep that in mind. I like my partners to be able to sleep at night also. I like to run a reasonably concentrated strategy. So position sizes in a sense should be aiming for that 5 to 10% kind of weighting. I think, the buy criteria, I've sort of outlined it, and the sell criteria is what gets tricky. And this is, a lesson I've learned from Bob, this notion of slow capital. So meaning being patient, going into an investment, as well as kind of having patience exiting an investment. And, I will sell under the following circumstances. If something is grossly overvalued, if there's something that threatens the long-term economics of the business, I will consider selling under those circumstances. And then if there's a superior opportunity in the portfolio and I don't have cash available, then, I might sell a 90-cent dollar to buy a 60-cent dollar.
Great. Did anybody else want to add something? All right. The next question is, what's your opinion on domestic chemical companies given the current low price of natural gas?
There's significant pressure on the profitability of those companies, and that's all predicated on importation around the world. And in spite of the fact that we have a huge advantage in terms of low. Now, of course, currently natural gas prices in the United States actually have ticked up, and so actually they're higher than they have been. Obviously, at a relative basis, they gone from 2 and change to 4 and change, and therefore 4 and change is still less than 11 or 12 is what you have in Europe. So therefore, there's a huge advantage. So we think they're really interesting because you can buy the assets probably for less than replacement cost. They're well positioned. They're going through a difficult times in terms of the current profitability. That is a transitory fact, and that gives you an entry point in. So on a 2-3 year basis, I can't see how you will make a lot of money in buying just about every chemical company in America. And we tend to look at the smaller ones, but that's true of the larger ones. So I think it is an opportune set of investments that have long-term structural advantages that their entry point today is really interesting. Let me ask what quick one. Someone asked about Strathcona.
Yes.
Curtis has looked at it. I visited with them. We know the company. It definitely, if it isn't in the basket, it can be in the basket. It's almost you could throw a dart. There's so many companies in Canada that trade at discounted valuations, oil and gas companies that pay dividends, buy back stock. The good ones are acquisition oriented because they continue to grow the numerator, and that is assets that therefore have earnings, and they do it with a minimal amount of equity, and therefore the per share numbers go higher. So it definitely is an interesting company. We've spent time, and I don't know if Curtis owns it or not, but I wouldn't be surprised if it is one of the ones he does own.
That was Strathcona Resources, Canadian listed oil sands.
Yeah, it came into the portfolio through a takeover.
Right.
I don't own it any longer because most of the basket is natural gas focused. But I think all the things that Bob said are true. The company's quite reasonably valued, probably highly discounted in the public markets for all kinds of reasons. And I think the Waterous folks seem like sensible allocators.
Thank you. I guess the other one is, can you update us on your current view of green first, given the current environment and tariff situation? I guess you could talk about tariff situations in general and how that might impact how you invest.
Right. So there's two things I'd say. One of them is that the company did raise money a year ago. That's how we became an investor in it. The money we raised for the company is to add a new line in one of their top plants to make it, a top quartile plant, and that capital spend is going underway and in the process. And so therefore we think the assets continue to improve. The environment continues to be tough. They fortunately have a really great relationship with Home Depot, and therefore they have a customer that is anxious to get the wood that they produce. Spruce, pine, and fir are mainly grown in northern climates. Most northern climates in which they grow are Canada. So God put the trees there. And the southern yellow pine is a different product. And therefore, retailers or home builders want both kinds of wood. And so it's an interesting dynamic. We think it gives you entry points into pretty much all the Canadian-related lumber companies at discounted valuations. They are going through a tough time. But yet, more importantly, over time, to the extent that the balance sheet is such that you're a survivor through the business, the opportunities will change and the earnings power will manifest. And we think the earnings power of the business is dramatically higher than where it is. And we think they're taking steps to do things to improve the business, to better position it when that improvement comes.
Great. All right. Isaac, next question is really for you in terms of, where you're investing in the world and where you're seated, and in terms of the team at Robotti, the infrastructure. Can you talk a little bit about the investment environment and, what benefits are you able to use and implement in your day-to-day research?
There's so many benefits from both the structure of how Robotti and Company runs and is administered, and then to the team of colleagues and how much overlap there is in certain investing. My passion is being a bottom-up stock picker, which is what I've done here for 20 years. We have an extremely strong infrastructure with excellent colleagues on accounting, compliance. Not every fund manager is passionate about running a fund management business, frankly, and I've always been passionate about stock picking. But being a global investor, the way that I've seen the firm evolve over many years now has become, more and more aligned with sort of my own interests. In the past, it was me bringing Bob and Theo Vandermeer to Ukraine, and now it's Spencer Sabelli coming into my office and saying, I've been looking at this company in Ukraine, and how leveraged to a political resolution do you think it is, and how valuable is it on a standalone basis? I mean, that's a market that's been of interest to us for a long time. That I've visited many times. Other people here have visited a little bit, but I've visited importantly before the original war broke out many years ago, and as well as since. And it's exciting for me, to run into like-minded ideas that are internally generated. And in the case of the company I'm mentioning that Spencer was excited about last year, it led to us, enlarging. It led to us investing more in a position that we had been invested in for years. So, it's the focus on ideas that is the most important for my process, and that would apply if I'm investing in Kazakhstan and Ukraine and Thailand, as well as if I were investing in Pennsylvania.
Hey, David, let me jump in here. I see a couple questions. One's build as first source. Another one is, again, the green
Housing.
first. Another is the housing. So first off, green first, that's mentioned that people ask that. Yes, I do have an investment in Green First, and it's a large percentage of that company. The fact of the matter is my larger investments are in Interfor and in West Fraser. So we've been an investor in the business for a long time. And of course, Builders First Source is the largest distributor of lumber and lumber sheet goods in the world, and we've been invested in this since '09. So they're all interrelated. And then the question is, yes, the building is slowing down because interest rates are high and multifamily is extremely weak. And you've answered the question. And because it is going through a difficult time, that is compressing the earnings. And yet the earnings power of the business is dramatic and identifiable. In the meantime, they continue to generate free cash flow. They continue to buy back stock. The chairman of the company bought $55 million worth of stock not long ago. So someone who knows what the hell they're doing, knows the business well, is opportunistic to buy it at an interesting position. So I do think the earnings power of the business is substantially higher, and they continue to generate free cash, buy back stock. So the outcome probably is positive. What do I think about housing? It clearly has headwinds. Headwinds at some point go to tailwinds, and the fact of the matter is the underlying fundamental is we need more housing. There isn't enough of it. The demographics are such that you need to build a lot more housing. So I think the future and the outlook for the business is strong. When that happens, again, the timing is uncertain, but the valuation and what you're paying for those businesses is extremely modest and interesting. So we think those are all compelling investment ideas that the market is giving them the opportunity, because if it doesn't make money in the next quarter, I don't want to own it. Sell it. Get out of it. And of course, we don't think that that's really, the question is what does it do in the next 2, 3, 4 years? And we think the outlook and the earnings power of the business is dramatically higher than where the market is valuing those companies today. And I also would point out, so more recently, of course, we do know that Valdo 13F and has big positions they established in Lennar and a smaller position in Horton. So somebody else thinks that housing is an interesting place. It's countercyclical. It's a place to invest. You can get in at an entry price that's significantly discounted, and yet the future is particularly bright in it. So I don't know. It's one of those 3 guys out in Omaha, and I think they're all pretty smart people.
Yeah, me too. That's great. Well, listen, it's we're past the hour. If we didn't get to your question, just email us. We'd be happy to set up a time to chat more. And that just concludes Robotti's mid-year update. Thank you for your time and continued interest in Robotti and Company. Remember, you can follow the New Silk Road Forum on Instagram and LinkedIn, and stay current on all things Robotti on X, formerly known as Twitter, LinkedIn, and Robotti.com. We look forward to updating you again later this year.